So yeah, I wanted to share today. So look, the idea behind these coffee with Callums were that we could kind of have an informal chat, but the way the LinkedIn Live is set up, it doesn't really work very well for that. So I think I can see your comments, but yeah, it doesn't really sort of set itself up nicely for a an informal chat. So what I'm going to do instead is just share some kind of musings on a few of the things that I've been thinking about. I've been traveling for the past couple of weeks. I was in the UK and then I was in Dubai. Um, and then last night I had the great pleasure of having Mark Matthews, who's the head of research for Julius Baer, um, came and did a webinar with us. Absolutely incredible content. If you were on that, let me know in the chat what were some of your key takeaways from that. But that was yeah, really good event. Um, and he kind of yeah, so I basically wanted to look at two ideas today. The first is around making money, and the second is around investing money, both of which are incredibly hard. And by like this isn't a pre-prepared presentation or anything, so excuse me if I go off topic. Um, but a lot of what I've been working on over the last couple of weeks is helping companies to make money and also raising money from investors. And both of these things are exceptionally hard to do, as any entrepreneurs will know, and anyone that's an investor will know how difficult it is to make money in investing. Um, so if you are an investor, let me know what you're currently investing in that's working for you. On the topic of kind of making money, so let's start with that. One of the earliest bits of advice I got from a mentor was he had noticed a pattern that that entrepreneurs have a habit of coming up with good ideas and then trying to attract customers and attract money to them. Um, and what he had always advocated was it's always much better to go where the money is. So find where the money is, find what people are already paying for, and then find a way to make what you do slightly better, slightly more compelling, and take a slither of a lot of money rather than trying to create a new fountain of wealth yourself. This always made a lot of sense to me, and it's advice that I pass on. I see a lot of startups with great ideas, but the market isn't ready for them yet, and I made that mistake numerous times myself. Um, One of the that kind of very much shaped my thinking around working with startups. Basically, startups don't have a lot of money. And so I see a lot of startups wanting to serve the startup market because that's what they're passionate about. That's what they enjoy doing. But if there's no money there, then you're really not going to make a lot of progress. And you may think, well, okay, but there's money around that ecosystem. There's angel investors, there's venture capital. But actually, if you dig beneath the surface, most angel investors don't make money from their investments. And the price of entry for an angel investor used to be around $100,000. Now it's $5,000, $10,000. Crowdfunding, you can put in like $500. Actually, angels, there's not a huge amount of money there. And even venture capitalists who have done a phenomenal job with PR. Most venture capitalists don't make money. It's an incredibly difficult space. And so if you look at that whole startup, angel, venture capital part of the economy, it's tiny. So the economy is around $100 trillion at the moment. Startup makes up, I think it's 1.4%. That whole VC space makes up about 1.4% of that, which is a very small proportion of the total economy. So um, I made a decision probably 15 years ago that I didn't want to play in that space anymore. It was very competitive, and it's basically people going after scraps of money. And another really interesting bit of knowledge that has impacted a lot of my thinking around creating wealth is around the difference between retail and wholesale. So when you see adverts for trainers or adverts for cars or adverts for clothes, these are all retail. This is consumers spending money. And yet retail consumption is less than 5% of the entire economy. So 5% is retail, 95% is wholesale. So wholesale basically means that it's the part of the economy that's supporting the retail. So uh, those Nike makes its trainers, that's retail, but they buy the rubber from somebody else. They have factories, they have all of this supply chain. And it's in that, and it's in real estate, and it's in commercial, and it's in bonds, and it's in finance that 95% of the economy is. And yet, if you look at most entrepreneurs, most early stage entrepreneurs, what they do is they focus on consumer products because that's what we see. That's what everything is around us is consumer products. Yet, if you want to skate to where the puck is, if you want to go to where the money is, you would play in the wholesale space. You would say, okay, how do I become a component in somebody else's business? And I think that's a certainly an idea that I have maintained. I find it much easier. You basically have most entrepreneurs chasing after the consumer market, making apps for consumers, for example, or AI products for consumers, and yet the real wealth sits behind that. It's in uh, the the outlets to reach consumers. So that has sort of been very much on my mind at the moment. There's been a couple of interesting examples around that as well, and I think and just because I've been seeing quite a lot of early stage businesses. A lot of people are obviously in the AI space right now, and everyone is claiming that they're AI, and yet the people that are going to make the most money have been in AI for years. And they're anyone that's kind of coming into it, Johnny come lately, is really going to struggle to do that. Obviously, we see that's where the money is going. But a little bit like the internet, there's going to be a few years of bubble, and then there's going to be a shakeout, and AI will just be a default in almost every product. So there's still tons of money to be made in that. But if you've never done anything in AI before, that's a difficult place to be thinking of about making money. Let me know if all of this is resonating, making sense to you. Let me know in the chat. Um, so that's interesting. That whole kind of being on the bleeding edge is a very cool space to be. It's not a very good space to make money in. It was a space I came from a tech background, and so I loved bleeding edge tech. I loved being on that front line, but it's very difficult to make money in that. In fact, one of the smartest business models that I've seen was a German company called Rocket Internet. And what Rocket Internet realized was the Silicon Valley mantra of just get out there, break things, deploy, find out what works, and throw money at the problem to scale it, was building a lot of basically good ideas, but second tier technology. So if you think about it from the perspective of um, somebody at Silicon Valley is inspired by the whole Valley story. They come up with a great app or a great business idea. They start scaling. They adapt as customers want it. They're building legacy or they're building technology on top of legacy ideas. They're kludging it all together. They're scaling up quickly. Obviously, most companies don't even get to that level, but the ones that break through, the ones that capture an idea that works, um, often the idea is right. The product's a little bit clunky because it hasn't been designed well. It's been designed to iterate very, very quickly. So what Rocket Internet did was it was a couple of brothers. They would wait until a business idea had proven traction in Silicon Valley, and then they would re-engineer it backwards and build it well and build it to scale. And so, for example, when Groupon took off, I know that wasn't Silicon Valley, it was Seattle, I think. But when Groupon took off, it was a great idea, but the execution was quite clunky because they were just scaling so quickly. And so what Rocket Internet did was they built it from scratch, using the same concept, but designed properly, from day one to scale. And they ended up being much, much more profitable than Groupon, and Groupon ended up buying them very quickly, and then asking them to come in and help manage Groupon. So that was quite a smart approach, and definitely something that I think is worth looking at when you see all of these people rushing into AI to make money. Um, to my mind, I'm not getting involved in anything in that space right now, not least because it's just moving so quickly. Anything that seems like a good idea when it's launched today is almost definitely going to be given away for free and embedded into somebody else's product in 3 months' time or 6 months' time. So it's a tricky space to make money as an entrepreneur. I think it's a tricky space to make money as an investor as well. But there's still huge amounts of money flooding into it. So let's talk about investment for on the other side of things, because it's incredibly difficult to make money as an entrepreneur. It's also incredibly difficult once you make that money to know where to invest it. I had an early mentor of mine who was slightly paranoid, um, and absolutely hated the fact that she would lose money on a lot of her investments. She knew how hard it was to make up her wealth, and then she hated the fact that a currency exchange could or a currency could go down 20% and she would lose 20% of her wealth. So she was incredibly diversified, and she ended up admitting to me one drunken evening that she had 25% of her wealth in gold bars in a safe underneath her fridge. Um, uh, which, yeah, I kind of, at the time, I thought it was complete sheer lunacy. Now I think she might be onto something. It's not something I'm willing to do just yet. But it was an interesting idea. When you look at what's going on with the economy, and I find it kind of interesting. I raise money for numerous projects. Um, I sit on the boards of numerous companies where understanding the economy and understanding the value of shares is obviously incredibly important. What's interesting when you have a presentation like Mark Matthews yesterday, who is very much a global economist, and the data that he presents is what Julius Baer Private Bank presents to its high net worth and ultra high net worth investors about what's going on in the wider economy, where interest rates are expected to be based on historical data, based on trend lines, which regions are doing well, which regions aren't doing well. Um, and obviously, as an economist, he's a huge believer that with enough data, you can make very good predictions about where markets are going. I've always kind of struggled with this. I think probably because I've been predominantly in the small business space. I kind of have a feeling that small businesses, to a certain extent, are a little bit immune to an economy. So you can be in an industry that's going down in an economy that's in a recession, but with a bit of luck and the right business model, you can still do incredibly well. Conversely, you could be in a growing economy in a a growing sector in a booming economy, and a badly managed company will still go backwards. So I think small businesses have an independence to the wider economy, but I think it's very useful to understand what's going on in the economy. Equally, I've interviewed people that are traders. Now, traders have a different view. So Mark Matthews will look at your stock and look at your industry and say, based on these industry trends, I would be investing in these kind of sectors. And so if your company is in this sector, there's a good chance the share price will go up. Then you go and talk to somebody like Jason Greystone, a friend of mine who is an incredibly talented trader. And he won't even look at the industry sector. He's just basing it on what's going on in the charts. And he'll say, based on the charts, your company is likely to go up or it's likely to go down. He'll draw some fancy lines and he'll talk about Fibonacci sequences and coffee cup handles and candles and various other things, and make his predictions based on that. Not interested at all in what's going on in the wider economy. And then you'll have the business owners themselves who genuinely believe that the share price should be a reflection of the underlying fundamentals of the business. So, yeah, our revenue is going up, our profits are going up, the share price should go up. Yet that doesn't work either. There's plenty of companies that have got zero profit or losing money and the share price is going up. There's plenty of very, very successful, profitable companies where the share price might be flat or going backwards. None of these things on their own are correct or incorrect. The sort of, I guess the one thing driving everything that we do right now in terms of our investments is around understanding what other investors are doing. And ultimately, whether you're a startup or whether you're a publicly listed company, you really need to be making your investment decisions based on the likelihood or the probability of what other shareholders are going to do. So if you invest in a startup and there's only one other shareholder, but that shareholder uh, declares that they want to exit, you're going to be exit liquidity. If you come in and you take the founder's shares, your exit liquidity for that founder. This is one of the big concerns, and this is one of the problems with the stock market. There's just not enough demand for all of the stock that's flowing into the market. And so new listings in the last 4 years are actually down 40% over the mean. So it used to be that if you could get into a new listing early, you had a very strong chance of it outperforming the wider market. Today, that doesn't exist. And partly it's because everyone runs for the hills once they see an IPO as an exit strategy. So the founders want to take money off the table, early investors want to take money off the table, the investment banks that took them public want to take money off the table. And so you have this massive imbalance of supply side versus demand. Um, and so ultimately, regardless of what's going on in the economy, regardless of what the chart looks like, or regardless of the fundamentals, all investment returns are determined by the buy and sell, the supply demand ratio. And so trying to control that, and the only way you can control that is either to hype demand or to control supply. Now, the approach that we take is to control supply, but I think when you are making investment decisions, it's incredibly important to take all of these areas into consideration. And actually, what you find is while there's definitely maxis in the economy that will say, no, I only make my investment decisions based on economic data. There's definitely maxis in the trading world, and there's definitely maxis in the fundamentals world. Actually, I think the best investors use all of those as data and will make their decisions accordingly based on that. So again, let me know in the chat whether any of this is oh, crikey, lots of comments. Making making sense to you. and what you're investing in at the moment, because that is always interesting to me. And I want to share with you um, uh, an experience of the FOMO that all investors fear of missing out. So for all of the idea that we all think we're rational investors, where we will um, make the best decisions on the best data. Um, what actually tends to happen is we like to look at what other people are doing, what other people are investing in. And I'll give you a great example of this. So as a sort of, again, kind of big picture macro, if you look at the economy of the 19th century, it was very much built on gold. So ships going out around the world, buying things with gold, buying spices, all of that sort of stuff. The fiat economy was backed by gold. Then we moved into the 20th century, which is really backed by credit, and that allowed things to move much, much quicker. It sped up the economy, allowed us to do transactions much quicker, and the banking system and the financial system uh, premeditated that and really allowed the economy to boom. Now I think the 21st century is absolutely it's all going to be digital. So crypto ultimately. And look, knowing that, then clearly so I'm making a decision that a large proportion of my investment is going to go into digital assets. You can be directionally correct and still get things hideously wrong. And something that I am very, very conscious of, and in fact, it was brought back to me yesterday, and Mark Matthews gave the example of if 30 years ago you had been told that the Chinese economy was going to expand 42 times over the last 30 years, um, you would understandably think that investing in China was a very good idea. You would absolutely assume that investing in the Chinese stock exchange stock market would be a great idea. And yet Chinese stock over the last 30 years has underperformed US Treasury bills, whereas the US market in an economy that's only grown very, very slowly has significantly outperformed everyone else. By the way, looking forward, he was very bullish on the Chinese stock market over the next 5 to 10 years. Um, Also very bullish on the Indian market, which surprisingly, while the Indian market has grown, the Indian stock market has also done quite well, even though the Indian currency is down about 60% over that period. So you can be directionally correct and still get this very, very wrong. And another great example of this is if you went back to the mid 90s and there was and I think this is very relatable given the hype around AI right now. So if you went back to the late 90s and you said, okay, this whole internet thing sounds really, really exciting. Um, I'm going to make my bets that it's going to be e-commerce and it's going to be search are the ones that are going to dominate. Now, in the mid 90s, if you had made, say, 10 bets on 10 different companies or 5 companies in search and 5 companies in e-commerce, there's a very, very strong chance that none of those companies would still be alive after 2001. Um, but we look at the two standouts. So we look at Google and we look at Amazon. Um, but if you look at all the other search engines, you look at Alta Vista, Ask Jeeves, they all kind of went the other way. Most e-commerce companies failed horribly. Um, and also, if you look at Amazon, Amazon's share price after the dot-com boom languished for a very, very long time. But now, if you look at it today, any equities investor so any startup investor or angel investor or venture capital will look at the success of Amazon and they'll look at the success of Google and they'll say this is a great example of why our industry is amazing. Like got in, we could have made thousands and thousands of percent if we had bet on Google or Amazon. An equities investor will look at those same two companies and they'll say, yes, but 90% of the wealth creation for Google and for Amazon has happened since they went public. So it wasn't in the first few years. It wasn't those angel investors. We all hear those stories about the guy that put 1 million into Google and is now worth billions. Um, or yeah, there's always these survivor biased stories. But what's interesting is 90% of the wealth happened after they went public. So again, you can be directionally correct, but get it horribly, horribly wrong. And just going back to crypto, and I will wrap up because we're coming to the half-hour mark. Um, a a contact of mine I've done some business with in the crypto space over the last few years had let me know that he had a token coming out, and it was going to be in the next few weeks, next few months, and so I was quite happy to stick, make a little punt on it. Um, and then I woke up yesterday morning and he had released it the night before. He'd released it. He's in the US, I'm in Singapore. Um, and by the time I looked at the price, it was up 17,000%. Um, so he'd released this token overnight. Everyone had bundled into it. The token was up 17,000%. There was already a video out on YouTube, somebody that put 30 grand in and was up to 20 million grand. Sorry, to 20, sorry, 17 grand. Sorry, they put 30 grand in, they were up to 2 million. It was up 17,000%. I thought, look, it's exciting, but yeah, clearly it's that's not sustainable. I've kind of missed the thing. Um, and I was busy anyway. I didn't have time to start moving tokens around and coins around, and so I didn't do anything. And I was complaining to a friend of mine that I had missed out on this 17,000%, which would have been a rather nice return. Um, and when I went to bed last night, it had gone from 17,000 to 54,000% return. So it had increased 300%. So if when I'd woken up, instead of bitching and moaning, I had actually put some money in, I would have got a 300% return in the time I was awake and before I went to bed. When I woke up this morning, all the gains were gone. So clearly some big whales had decided to cash out, and that had created a run on the token. And today the token is pretty much back where it was right at the beginning. So I think that there's, as investors, even with the best knowledge in the world, we all suffer from FOMO when other investments go up. But occasionally we suffer from uh, F TFMO, which would be thank I missed out on that one. Because if I'd gone in at the top and 99% of it had been wiped out, I would have been very sorry for myself. So yeah, look, making money is difficult. Investing money is very, very difficult as well. I do have some, this was sort of just a random spitball of ideas. I am pulling it together because one thing I do kind of think is that if you want to make money, you need to be where the money is, and investing money and helping people solve investment problems is a great place to be. And I'm going to be putting out some products and some networks around that over the next few months. So if that's a space that you're interested in, do stay in touch. Thank you for joining this call. Apologies, I didn't, it's very difficult to kind of get to all the comments. But yeah, thank you very much. And I will see you on the next Coffee with Callum now that I've kind of worked out